CFA Learning Study. Reading #3 Session Number 2 Financial Management. Topic is Financial Management and Financial Objectives. This chapter covers a range of sources of short and long-term finance. Section B questions may require a discussion of sources of finance. Debt finance. Islamic finance. Main topic. Overdrafts. Points related to overdrafts. Designed for day-to-day help. Only pay interest when overdrawn. Bank has flexibility to review. Can be renewed. Other finance terms: partial, faded, venture capital. Equity finance loans. Won't affect gearing calculation. Bank won't withdraw at short notice. Shouldn't exceed asset life. Can have loan overdraft mix. Loan interest rate usually lower than OD rate. Medium-term purposes. Interest and repayments set in advance. An interest-free short-term loan. Risks: loss of supplier goodwill. Cost is loss of early payment discounts. A contract between the lessor and the lessee for the hire. Lessor responsible for servicing and maintenance. Debt finance. Availability depends on size of business, duration of required finance, fixed or floating rate. Security and covenants. Deep discount. Are issued at a large discount to the nominal value of bonds. Zero coupon. Are issued at a discount, with no interest paid on the redemp. Is the repayment of bonds at maturity. Convertible. Give the holder the right to convert to other securities, normally ordinary shares, at a predetermined price, rate and time. Conversion premium equals current market value of bonds, conversion value of bond. Venture capital. Equity finance. Venture. Is risk capital normally provided in return for an equity stake and possibly board representation. Very high growth potential. Very significant amounts. Very high returns. Equity finance. Stock market listing. Is raised through the sale of ordinary shares to investors via a new issue or a rights issue. Access to wider pool of equity finance. Higher public profile. Initial public offer, IPO. An IPO occurs when the company sells shares to the public at large for the first time. Offer for sale by tender means allotting shares at the highest price they will be taken up. Benefits, advantages of an IPO: higher investor confidence due to greater scrutiny. Allows owners to realize some of their investment. It seems the text is truncated, but likely refers to the directors' or owners' investment, shareholding. Allows use of share issues for incentive schemes and takeovers. Placing. Placing means arranging for most of an issue to be bought by a small number of institutional investors. It is cheaper than an IPO. Associated costs, fees, likely related to issuing shares in general, issuing house, solicitors, auditors, public relation fees. Printing and distribution costs. Advertising. Venture capital. Price of similar companies. Current market conditions. Future trading prospects. Premium on launch. Price growth after launch. Higher price means fewer shares and less earnings dilution. Rights issue. A rights issue is an offer to existing shareholders enabling them to buy new shares. The offer price will be lower than current market price of existing shares. Value of rights. The value of the rights is calculated by the difference between the theoretical price of the share after the rights issue and the new shares issue price. Value of rights equals theoretical X rights price issue price. The image also references a TERP example, which stands for theoretical X rights price. Advantages of rights issue. Lower issue costs than an IPO. Shareholders acquire more shares at a discount. Relative voting rights unaffected. This is generally true if all existing shareholders take up their rights proportionally. Murabaha. Trade credit, loan. Pre-agreed markup to be paid, in recognition of convenience of paying later, for an asset transferred now. No interest charged. Musharaka. Venture capital. Profits shared according to a pre-agreed contract. No dividends paid. Losses shared according to capital contribution. Musharaka. Equity. Profits shared according to a pre-agreed contract. No dividends paid. Losses solely attributable to the provider of the capital. Ijara. Leasing. Whether operating or finance transaction, in Ijara the lessor still owns the asset and incurs the risk of ownership. The lessor is responsible for major maintenance and insurance. Ijara. Leasing. Whether operating or finance transaction, in Ijara the lessor still owns the asset and incurs the risk of ownership. The lessor is responsible for major maintenance and insurance. Sukuk. Bonds. There is an underlying tangible asset that the sukuk holder shares in the risk and rewards of ownerships. This gives the sukuk properties of equity finance as well as debt finance. Thanks for watch. Like, subscribe, share and comments.